Hello everyone, and welcome back to the channel. Today, we're diving into the fascinating world of options, with a special focus on call options. Whether you're new to the financial markets and want to understand the basics, or you're looking for a refresher, this video is designed to help you learn. By the end of this, you'll understand what call options are, how they work, and their role in the financial markets, with a deep dive into key concepts like volatility. So, grab a notebook, get comfortable, and let's get started. First things first, what is a call option? In simple terms, a call option is a financial contract that gives you the right, but not the obligation, to buy a specific stock or another asset at a predetermined price within a set period of time. That predetermined price is called the strike price, and the set period of time is known as the expiration date. Think of it like a coupon that lets you buy a stock at a set price, even if the market price rises, but only if you act before the option expires. So why might someone consider a call option instead of just buying a stock outright? Great question. Call options are a unique tool because they offer leverage, meaning you can control a large amount of stock for a relatively small cost compared to owning the stock itself. They also allow you to benefit from a stock's price increase without owning the stock. Additionally, they can serve as a way to manage risk in a portfolio. Intrigued? Let's break it down step by step. To understand call options, let's look at their key components. Every call option has four main parts: the underlying asset, the strike price, the expiration date, and the premium. Let's go through each one. The underlying asset is the stock, index, or other financial instrument the option is based on. For example, if you buy a call option for Apple stock, Apple is the underlying asset. The strike price is the price at which you can buy the underlying asset if you choose to exercise the option. For instance, if you buy a call option with a strike price of $100, you have the right to buy the stock at $100 per share, no matter how high the stock's market price rises. The expiration date is the deadline for exercising the option. After this date, the option becomes worthless if you don't use it. Options can expire in days, weeks, months, or even years, depending on the contract. Finally, the premium is the price you pay to buy the call option. It's like the cost of that coupon we mentioned earlier. The premium is determined by factors like the stock's price, the strike price, the time until expiration, and market volatility. We'll dive deeper into these factors, especially volatility, in just a moment. Now let's walk through a real-world example to make this crystal clear. Imagine you're looking at a company called Trend, which is currently trading at $100 per share. You've noticed some market signals suggesting Trend's stock might rise in the next month, perhaps due to a new product launch. To illustrate how a call option works, let's say you buy a call option for Trend with a strike price of $105, expiring in 1 month, and the premium is $4 per share. Since one option contract typically represents 100 shares, you pay $400 for the premium. That's $4 times 100 shares. This is a small cost compared to buying the stock outright. Fast forward a month, and Trend's stock has risen to $120 per share. Your call option gives you the right to buy 100 shares at $105, even though the market price is now $120. If you exercise the option, you'd buy the shares for $105 each, spending $10,500. You could then sell those shares immediately at the market price of $120, receiving $12,000. That's a $15 per share difference, or $1,500, minus the $400 premium you paid. That results in a $1,100 difference. But here's a key feature of call options. You don't need to exercise the option to benefit. Many people who buy options don't exercise them. Instead, you could sell the call option itself, which has likely increased in value because the stock price rose. For example, the option's premium might now be worth $12 per share. So you sell the contract for $1,200, resulting in an $800 difference after subtracting the $400 premium you paid. This flexibility is a big reason call options are an important part of the financial markets. Of course, there's a downside. If Trend's stock stays below $105 by the expiration date, your option expires worthless, and you lose the $400 premium. That's the risk with call options. Your loss is limited to the premium you paid, but you can lose it all if the stock doesn't rise above the strike price. Let's talk about the main purposes of call options in the financial markets. There are two primary roles: benefiting from price increases and hedging. Let's explore each one. First, benefiting from price increases. This is when someone buys a call option because they expect the stock price to rise. In our tech trend example, the call option allows you to gain from the stock's increase without owning the stock. Because options are less expensive than buying stocks directly, they can amplify the financial impact of a price movement, but they also carry the risk of losing the premium if the stock doesn't rise. Second, hedging. This is where call options can act as a form of protection. If you've sold a stock short, meaning you've borrowed and sold shares, hoping to buy them back at a lower price, you might worry about the stock price rising. A call option can limit your losses by ensuring you can buy the shares at a fixed price. For example, if you've shorted tech trend stock and fear an unexpected price surge, a call option protects you by capping the price you'd pay to repurchase the shares. This makes call options a valuable tool for managing risk in a portfolio. Now let's get into the factors that affect a call option's price, or premium. This can get a bit technical, but I'll keep it clear and focus on volatility, as it's a critical concept. First, there's the stock price relative to the strike price. If the stock is trading close to or above the strike price, the call option is more valuable because it's more likely to be profitable. This is called being in the money. If the stock is far below the strike price, the option is out of the money and typically less expensive. Second, time until expiration. Options lose value as they approach their expiration date, a concept called time decay. The more time left, the higher the premium, because there's more opportunity for the stock to rise in your favor. Third, volatility. This is a big one, and it's worth spending some time on because it's central to understanding options. Volatility refers to how much a stock's price tends to fluctuate. There are two types of volatility that matter for options: implied volatility and realized volatility. Let's break them down. Implied volatility reflects the market's expectation of a stock's future price fluctuations, as embedded in the option's premium. It represents the anticipated annualized price range, expressed as a percentage, within which the stock price is expected to move with a 68% probability, one standard deviation, over a year. For example, if tech trend has an implied volatility of 20% and its current price is $100, the market expects the stock price to fluctuate between $80 and $120 over the next year, with a 68% likelihood, based on current option pricing. This expectation is derived from the option's market price, using models like the Black-Scholes formula. High implied volatility means the market anticipates larger price swings, increasing the chance that a call option could become in the money, so the premium is higher. For instance, if tech trend is about to release a new product and traders expect significant price movement, implied volatility will rise, making call options more expensive. Implied volatility is dynamic. It often spikes before events like earnings or product launches and drops afterward when uncertainty decreases. Realized volatility, also called historical volatility, measures how much a stock's price has actually fluctuated in the past, typically over a period like 30 days. It's calculated by analyzing historical price data and determining the standard deviation of daily price changes, annualized as a percentage. For example, if tech trend's stock price has varied significantly over the past month, its realized volatility might be 30%, indicating substantial past price swings. Realized volatility is backward-looking and provides context for a stock's historical behavior. While it doesn't directly set the option's premium, it helps you compare implied volatility to past price movements. The interplay between implied and realized volatility is key. If implied volatility is high but realized volatility has been low, it might mean the market is overestimating future price swings, potentially making options pricier than justified. Conversely, if implied volatility is low but realized volatility is high, options might be relatively cheap. Understanding both helps you grasp why an option's premium is priced the way it is. For call options, higher implied volatility increases premiums because it raises the likelihood of a significant price increase, making the option more valuable. Finally, interest rates and dividends can also affect premiums, but they're less significant for most learners. Higher interest rates can slightly increase call option premiums, while expected dividends can decrease them. At this point, we're about 2/3 through the video, and I hope you're finding this informative. If you're enjoying the content, please take a quick second to hit that like button. It really helps the channel grow. And if you want more educational videos like this, don't forget to subscribe and click the notification bell so you never miss an update. Thanks for your support. Let's talk about some key concepts to understand when learning about call options. First, it's important to know the underlying asset. Whether it's a stock, an index, or another instrument, understanding what drives its price movements, such as company performance, market trends, or economic news, can provide context for how call options behave. Second, consider the importance of risk awareness. The premium you pay for a call option is the maximum amount you can lose, which makes options different from other financial instruments where losses can be larger. However, because options can expire worthless, it's critical to understand this risk up front. Third, pay attention to the expiration date. Short-term options are less expensive, but require the stock to move quickly to be in the money. Longer-term options cost more, but give the stock more time to move, affecting their value differently. Fourth, familiarize yourself with the Greeks. Metrics like delta, which shows how much an option's price changes with the stock price, and theta, which measures time decay, provide valuable insights into how options work. Most trading platforms display these metrics for educational purposes. Finally, consider exploring options through educational tools. Many platforms offer resources like paper trading accounts, where you can simulate buying and selling options without using real money. This can be a great way to learn how call options function in a risk-free environment. Now let's cover some common pitfalls to understand when studying call options. One major one is focusing only on options with very short expiration dates because they're cheaper. These options are less likely to become profitable unless the stock rises significantly and quickly. Another pitfall is overlooking the bid-ask spread, the difference between what buyers are willing to pay and what sellers are asking. A wide spread can affect the cost of entering and exiting a position, so it's worth understanding liquidity in options markets. Also, it's important to avoid making assumptions based on hype. Just because a stock is rising or trending on social media doesn't mean a call option will automatically be valuable. Understanding the underlying reasons for price movements is key to grasping how options work. Phew, we've covered a lot today. Call options are a fascinating part of the financial markets, offering ways to benefit from price increases or manage risk through hedging. They come with unique characteristics, so education is essential. I hope this video has given you a clear understanding of what call options are, how they function, and the critical role volatility plays in their pricing. Before we go, I'd love to hear from you. In the comments below, tell me, what's something new you learned about call options or volatility today? Or what other financial topics would you like me to cover in future videos? Your feedback helps shape the channel, so drop your thoughts below. Thanks for watching, and if you found this video helpful, please give it a thumbs up and subscribe for more educational content on finance and markets. Until next time, stay curious and keep learning. Let's revisit volatility with more context and intuition. Remember, implied volatility is what the market expects. Realized volatility is what actually happened. Comparing them can give you an edge in deciding whether an option looks expensive or cheap relative to recent history. If implied volatility spikes before an earnings report, the market is pricing in uncertainty. After the report, IV often collapses, a phenomenon traders call volatility crush. If you buy options into that spike, you may suffer rapid IV decay after the event, even if the stock moves in your favor. This is why many traders avoid buying options right before major events, unless they expect a very large move. Alternatively, some traders sell options into high IV to collect premium, but but that strategy carries large risk if the move is bigger than expected. A simple exercise. Compare current implied volatility to the realized volatility of the past 30-90 days. If IV is much higher than realized, the market expects future turbulence. If IV is lower, options may be relatively cheap compared to recent history. Let's briefly revisit the Greeks and why they matter for practical trading. Delta tells you how much the option price changes when the underlying moves. Theta tells you how much value the option loses each day due to time decay. High theta can eat into short-term option positions quickly. Vega is the Greek that measures sensitivity to volatility. When implied volatility rises, Vega increases option premiums. When IV falls, options lose value due to negative Vega exposure. Understanding Vega helps you time entries around IV moves. Think like a buyer. You want IV to rise or the stock to move enough to overcome time decay. Think like a seller. You collect premium and hope volatility drops or the stock doesn't move much. Both approaches require discipline and risk management. Liquidity matters. A wide bid-ask spread increases trading costs and can eat profits. Focus on liquid options, tight spreads when possible, especially on short-dated contracts where spreads can be larger. Position size your option trades relative to your total portfolio. Because options can move fast, limit position sizes so a string of losing trades doesn't significantly damage your account. Use stop losses or defined risk strategies when appropriate. Call options can be used in many strategies. Buying naked calls for directional exposure, or selling covered calls against stock you already own to generate income. Each strategy has different risk profiles. Remember, options amplify returns and risks. A relatively small move in the underlying can lead to large percentage gains on an option, but you can also lose the entire premium. That asymmetry is the defining character of options. Emotions drive mistakes. Avoid chasing trades after big moves, and don't increase position size impulsively after a win. Keep a trading plan and follow it. Use tools, charting platforms, IV rank percentile analytics, option chains, and paper trading. These help you learn without risking capital and provide context for decisions. Going back to tech trend. If implied volatility rose before the product release, the premium would be higher. If you bought the call and IV collapsed afterwards, your position might lose value even if the stock moved up slightly. Quick checklist 1. Check Ivory versus realized. 2. Consider time to expiry. 3. Check liquidity and bid-ask. 4. Size your position. 5. Know your exit plan. Models like Black-Scholes estimate fair option prices but rely on assumptions. They help standardize pricing, but real markets can deviate, so keep models as guides, not gospel. If you get more advanced, multi-leg strategies, spreads, butterflies, can tailor risk-reward and reduce cost compared to naked options. These are worth studying after mastering single-leg basics. Options are powerful tools. Respect their risks, use education and practice, and make decisions that fit your goals and risk tolerance. Now let's wrap up with final takeaways and next steps. Key takeaway. Always compare implied volatility to realized volatility before judging whether an option is expensive or cheap. Second takeaway, time decay, theta, can be an option's biggest enemy. Know the Greeks for better timing. Third takeaway, always size positions to your risk tolerance and prefer practice via paper trading when learning new strategies. If you want a follow-up video breaking down Greeks or showing a step-by-step paper trade, let me know in the comments. I can build that next. Before we go, I'd love to hear from you. In the comments below, tell me, what's something new you learned about call options or volatility today? Or what other financial topics would you like me to cover in future videos? Your feedback helps shape the channel, so drop your thoughts below. Thanks for watching, and if you found this video helpful, please give it a thumbs up and subscribe for more educational content on finance and markets. Until next time, stay curious and keep learning.